Thank you all for joining in today. I think we've solved our sound problem from last week. Everyone is muted except for me, and then at some point we'll unmute everybody and entertain questions. So if you have any, you might post them to the chat, for instance, and we'll deal with them later. One of the things that I just wanted to do very quickly, I have our retirement assessment plan from last week, a couple of minor differences. But one thing that I neglected to cover, which I just want to touch on today, so I'm just going to reopen this, is the tax tactics, or are the tax tactics that are available. And I'm not going to get into this in a lot of detail, but only to mention that they can have a significant impact, they can have a significant impact on the plan. So there are two places where you can do this. On the Taxes tab, the Optimize button will go through, and if there are charitable donations, medical expenses, etc., it'll figure out which of the parties gets the greatest tax advantage, and it'll do it on a year-by-year basis. It'll do the same thing for splitting pension income, and then it will try sharing the CPP, QPP benefits. And what the Optimize will do is it'll conclude which of all of these strategies is the most tax effective and gives the maximum benefit. In this particular plan, Bill and Sue essentially have the same assets, the same RSPs, etc. So there's not a huge difference. The other thing is with withdrawals, one of the things you can do is you can optimize for tax brackets. So for instance, I could go in and say, I need $60,000 for example. The first 20 is going to be covered by OAS and CPP. Let's assume that. So what I want to do for the next $26,000, which takes me up to the first tax bracket, in round terms $46,000, I want to take that money out of my RRSP, a taxable source, and then the difference between the $46,000 and the $60,000 I need, that additional $14,000, I want to take out of a non-taxable source such as my TFSA. So I'm getting the $60,000 that I need, but I'm keeping all of my taxable income in the first tax bracket. And you can see, depending on the client, whether it's the first tax bracket, OAS clawback, second bracket, for instance. So those were two things that I just wanted to touch on because they can be very impactful. I was doing a coaching call perhaps a month or so ago, and an advisor had a client who was retiring from the federal government. He was going to get a $108,000 a year index pension plan. His wife did not have a great deal of retirement income, so clearly splitting his pension income was, going to have a good tax impact. But the other thing was that most of his OAS was going to be clawed back, and by splitting income, he got to keep the OAS. So we were talking several $1,000s a year over 30 years of the plan. So when you put it all together, keeping money, earning a return on it, getting the OAS, lower taxes, and so on, the advantage in the tax optimization was about $500,000. So a very, significant tactic. So I'm going to close out of this retirement assessment plan, and you'll recall that a retirement assessment doesn't deal with wills, and in the solutions area, it doesn't have any estate output or doesn't deal with insurance. It's intended to address the question, will I be okay in retirement? So what we want to do now is we want to convert this to, I've got to just close something here. We want to convert this to a retirement and estate assessment plan. And all we need to do is run VisionWorks. Here's our retirement assessment plan in the list. We'll just click the Edit button, select retirement and estate assessment, and I'm just going to make a little note. So retirement assessment to retirement and estate assessment. Click the OK button, and it's automatically converted. And what we see now is we have the will page in the navigation pane on the left. And if we go down to solutions, we have the estate and insurance output. The other thing is that from a retirement point of view, we're still operating with the same concept. So if we go to general expenses, you'll remember the idea pre-retirement is that the general expenses are just showing a zero entry, and then they're showing the desired retirement income during retirement. You'll remember we've itemized home expenses, vehicle expenses, and if you'll recall, we reduced the general expenses from $60,000 to $50,000, and what we did was we added in a $10,000 vacation because we were able to then control that later in life and not assume we were still taking those vacations, at age 95. So the idea, remember, before retirement is that we can only do two things with money. We can either spend it or we can keep it. And by keep it, I mean save it in a savings account, move money into a non-registered portfolio, contribute to a TFSA, contribute to an RSP. So the concept behind a retirement plan is very simple. What have you got in the pots? What are you adding to them every year? Contributions, your keep. What rate of return are they earning? And therefore, how big will the pots become retirement? And then given your desired spending, will those pots last? So pre-retirement, we're interested in what are you keeping, and the underlying assumption is that everything you haven't itemized is just being spent. We don't know where it's being spent, we just know that it's being spent somewhere. You can either spend money or you can keep it. If you've told us what you're keeping, then we have to assume everything else is spent. So in that pre-retirement period, we just zero out general expenses to control all of that in the background. So what we want to do today is we want to focus on wills. And you can see, of course, in this plan, we just have Bill and Sue. So obviously what we need to do is we need to add other parties. If we go to the About page, we can certainly use the Add button and bring in Bill Jr. and so on. But what we have is a questionnaire for additional parties. So you remember our general questionnaires on the first page just have placeholders for two people, Bill and Sue. We didn't want to have each questionnaire have multiple placeholders for children, parents, etc. So what we did was we created a separate questionnaire for what we call additional parties. So you can see we can have household parties. They could be children, they could be parents, grandparents, whatever the case might be. And then down here, other parties. They can still be children, but they're adult children who aren't living with us, for instance, so not a household party. So there's lots of room to put in children, and I've done this already and created an FDF file, the standard thing that we do. And so what I'm going to do now is I'm going to go back to VisionWorks, and when we do the initial import from the retirement assessment plan, we're setting the whole plan up. So now that we want to do an extra import, we want to import the additional parties, then what we have to do is go to this Import Export Questionnaires page, go to Import from Questionnaire, locate that FDF file from the additional parties questionnaire, and you can see I called this Smith, Bill, Sue, Children, and then simply open it up. Again, it can have a password, but what we now have is we have Joan and Bill Jr. added to the plan, and if we go back to the About page, we can see that they're automatically added to the tree view. So let's have a look at wills and understand the general concept behind them. Basically, wills do three things. One is we can speak about a dollar allocation, and a dollar allocation is a specific amount. I bequeathed my niece Susie $25,000. It doesn't matter if I die today or 30 years from now, she's going to get $25,000. Now, I want you to notice, if we have niece Susie, that if we open up this beneficiary list, she's not there. We cannot click the Add button and add Susie to the plan because of all the relationship, tax, estate status that we have in the background. So if we want to add niece Susie to the plan so that she can show up in the estate output in the report, we have to go to the About page and add her in, and then her name will be in this list. If all we want to do is account for the $25,000 that's going to niece Susie, we really don't care, to have her explicitly showing in the report. Then we can use non-party and then just put in the amount. And it may be that we have several grandchildren, each of whom will get $25,000, so we just use non-party once and then add up whatever that total might be. Another thing that a will does, of course, is it speaks in terms of beneficiaries for specific assets. So I'm just going to go through for a moment, and if we go to the Joint tab, we can see that the house is joint tenant. Now, joint tenant property, of course, is outside of the will, but we include it on the Will tab just so we can, see that it's available. And also because we need to be able to put in contingent beneficiaries. So, the way things are set up, Bill's half of the house is going to Sue, Sue's half of the house is going to Bill, but we also can put in a contingent beneficiary. In other words, if Bill dies, leaves his half to Sue, what's going to happen to the house on Sue's death? And one of the things that I just want you to notice is that for a principal residence, we default to the beneficiary being the estate. The idea being that in normal life expectancies, by the time Bill and Sue pass away, the children will be adults, they'll likely have their own home, and what they'll likely do for the home that they inherit from Bill and Sue is just liquidate it and take the cash. Little different, though, when we talk about something like a cottage, because in this case, there's a very good chance that we want to keep that asset. They're not making any more cottage property or waterfront property. So in this case, what we would probably want to do is actually add the children in as contingent beneficiaries. So I'm just going to add Joan and Bill Jr. to the plan. And we can see now that they've become the beneficiaries. Now, I want to do one thing here just for something that we'll do a little bit later when we have a look at the estate output. I'm actually going to go to the Entries tab, and I'm going to change the ownership of the cottage from joint to Bill. So the concept behind a will and what allows us to integrate the terms of wills into the financial forecast is that we treat assets as what I'm going to call an object. So the cottage is an object. It has a certain value, it has things associated with it like property taxes or whatever. And it's attached to the owner through their ownership interest. And then what happens on death is that that cottage, that object, continues to exist. But what happens is it's disconnected from the current owners on death and connected to the new owners. And that's essentially what a will does. By the same token, we're able to move assets around if we inadvertently put them on the wrong tab. So all I need to do here is merely delete Sue. Bill's now 100% the owner, and when I click Save, the cottage has disappeared from the Joint tab, and now we see it on Bill's tab. And the reason I want to do this is coming back to my belief that it's absolutely essential in today's world that we model terms of wills, integrate terms of wills into the financial forecast. And the reason is, of course, that we have a 40% national divorce rate. And if we talk in terms of what's called the silver set or the gray set, people who are older, children are grown, moved out of the house, the divorce rate's actually 48%. And if we talk in terms of the medical profession, et cetera, it's even higher. So a great many of our clients are divorced, and of those, again, a great many are in second marriages and have blended families. And what all financial planning software does is it assumes that on Bill's death, all of his assets are going to go tax-free to Sue, and then on her death, they're going to roll over to the children and be taxed at that time. Well, what we're looking at in this particular case is we're looking at a cottage in Bill's name. So I want you to assume that this is a second marriage blended family situation. In Bill's previous marriage, his former wife took the house, he took the cottage, it's his asset, and he can do with it as he wishes. So we'll just go to the cottage, and you can see right now I've got the beneficiary for Bill as being Sue. If we go down to Solutions, and we have a look at the Estate tab, and Bill's output, Sue's the sole beneficiary. She's going to get, the condo, that's just something I put in for a downsize. She's going to get assets named in the will, the cottage. I've got a piece of art in here that I want to use a little bit later. The remaining value of his RSP, TFSA, etc. And so if we look at taxes, he's got some liquid assets, non-registered portfolio. We'll come back and talk about that. Taxes at death, not very much, and you can click that button to have a look. Estate administration taxes, probate fees. So the liquid assets less the charges to the estate give the remaining residue, and in this particular case, all of it is going to Sue. So the picture looks quite good. But if we go back to the will tab and we say, well, in fact, the cottage is going to go to Bill Jr., Bill's son from a previous marriage, then what happens is capital gains, of course, are realized, and they're paid by Bill's estate. And the situation that we now see is that the estate is almost $500,000 underwater because of the large capital gains taxes on the cottage. So this is, I think, very commonplace. It's being neglected in plans, and as a consequence, I think, in a great many cases, we're actually giving people misinformation, and it could be substantial. So let's go back to the will tab. Needless to say, when it comes to assets like RSPs or TFSAs, their beneficiaries are designated within them. So what we're talking about is other types of assets, the cottage, the art, etc. So again, just to recap, the will does three things. There can be a dollar allocation. Let's actually put this in. We'll put in $10,000 for our non-party, our niece Susie. A dollar allocation, beneficiaries for specific assets, and then the final thing that a will does is it talks in terms of the residue of the estate and how it's going to be distributed. So with TFSAs and RSPs, for example, of course, we designate beneficiaries because we're actually talking about a trust, and therefore a trust has a beneficiary. When it comes to bank accounts and non-registered portfolios, with the exception of those that have seg funds, we can't designate a beneficiary for our non-registered portfolio because it's not a trust. And it would make no sense to say every time I bought and sold a stock or a regular mutual fund that I designated a beneficiary for it. It would be chaotic. So what happens is all of the assets in bank accounts and non-registered portfolios just go into a pot, and then that pot takes care of all of our terminal expenses, and because we don't know when we're going to die, we don't know what our taxes will be, we don't know what the value of the portfolio will be, etc. So whatever that value is, it's then distributed in terms of percentages. So what happens then when we go back to the estate output is, of course, we see Sue getting whatever she's getting, and then the non-party, the $10,000, Bill Jr. is getting this cottage, and we're getting this, huge tax bite, and the residue for distribution is quite negative, and that is actually all being accorded to Sue as the primary beneficiary. So we can see, what happens here. So what I want to do now is, and it goes without saying that most often what we're going to do is we're actually going to use insurance in order to, take care of this negative residue. But what I want to do is I want to suggest one other thing that's possible. So I'm actually going to create a new solution, and I'm just going to copy this, and I'm going to call this Donate Art, which is the reason that I added some art to the plan. And I'm just going to go back to the Will tab, and the art is in Bill's name as well. And all I'm going to do is I'm just going to change the beneficiary from Sue to Charity. And you'll notice I'm going to make this a cultural donation just because we get a bigger tax benefit. And now when we go back to the output, or the estate output, what we're going to see is that because of that very large charitable donation, we can see it here, we've ended up reducing the negative residue by a couple of $100,000. And I only mention it because very often, if we have a look at the art, let's go back so we can compare the two solutions together. Very often, if we look at the amount of insurance that somebody might require, it could be fairly substantial, to cover that negative residue because of the cottage, and it might be essentially unaffordable by the client. So we can also do things like look at other assets which the client might be able to donate. So again, this is sort of a values-based trade-off. What's more important? Keeping the cottage in the family is much more important than keeping that piece of art. So if we can donate it, get a tax benefit, lower the negative residue, then we're going to end up requiring less insurance. And then finally, the one other thing that I'm going to do just to show you this as a thought is I'm going to put in a level benefit policy, and I'm just going to reduce the death benefit to about $350,000. So again, the concept here is, Bill's got to come up with the insurance premium, and that could have a substantial impact on his retirement well-being. But I want to remind you, and we're not going to worry about the premiums being particularly accurate, but I want to remind you that Bill doesn't necessarily have to pay for all of the premium. If we're talking about keeping the cottage in the family, having it go to Bill Jr., there's no reason why we couldn't talk in terms of Bill Jr., an adult son, sharing the premium with Bill in some way. So just keep in mind that's also a possibility. Now, the one other thing I just want to show you is the death benefit, the beneficiary is Sue. So if we go back to the estate tab, we've got that estate distribution issue. By the way, that's a little bit higher because Bill's liquid assets will be less since he's paying those insurance premiums. But you can see the insurance benefits going to Sue. So we always think in terms of, an insurance benefit going to a specific person. in order to pass outside the will in order to avoid probate. So if we have a look at the estate administration taxes, $35,000, in today's terms, $18,000, because the insurance benefit is going to sue. But it's in fact the estate that has the issue, that has the liquidity issue. So I'm going to go back and change the beneficiary from Sue to Bill's estate. So notice I'll select estate here, click the save button, and now what we have is we have the benefit going to the estate, giving it the liquidity we need. Now I grant you we have now a higher estate administration tax, but if we look at it in today's dollars, it went from $18,000 to $21,000, a few $1,000s. And I would encourage you to consider that maybe sometimes the estate needs to be the beneficiary of the insurance policy because of it's the estate that actually needs the liquidity. And providing that benefit to Sue could lead to some legal issues if she wants to argue that it's the cottage that's causing the need. So we covered most of the will stuff that I wanted to look at. We will get to insurance in a moment. It's pretty straightforward. You can do a life, disability, critical illness, and long-term care analysis, 4 of them, for each of Bill and Sue. So in a total 8 insurance analyses. And I want you to notice up here, we're in the Donate Art solution. And when we go to the Insurance tab and select Life, what we actually did was we set up a sub-solution, Life Needs Bill. And the purpose of this is so that we can go in and make changes to see what the impact would be on the plan if, Bill died today. So we've done a calculate. It's not showing an additional need. But the question to Sue might be, if Bill died today, how would life change? So the point of doing this sub-solution is to be able to go in and make changes specifically in order to understand the insurance needs. So Sue says, if Bill dies today, I don't want to work anymore. So I'm going to go to the Entries tab, and I don't want to switch to the main solution, Donate Art. I want to continue within the sub-solution, and I'm now going to go to Sue, Career, her salary, and I'm just going to delete it and end it. Now notice we do everything as of the end of the year, so we can't delete that first year. Now what we're going to do is we're going to do a save, and now we'll go back to Bill's tab, back to his life insurance, and we'll do a recalculation. And you can see what happens is that having no need, we now have a need because Sue's not going to work anymore. So now $366,000. The other thing that I would encourage you to also look at is how Sue's invested. So the idea being that Sue may be, a relatively growth-oriented investor. In this case, it's actually quite low, but she could be a growth-oriented investor. But if Bill died, left the insurance benefit, and if Sue needs to live off of it, she may well want to be a much more conservative investor. So we could then go in and change portfolio allocations from a growth type of portfolio or a balanced type of portfolio to something that's very conservative. And again, that would have the impact of increasing the need. So the idea of the insurance sub-solution is to be able to say the one thing we know is if Bill died today, things would change. The question is, how might they change? Sue doesn't want to work anymore. She wants to be a more conservative investor. We don't need 2 cars, we only need 1. So a few major changes like that will yield a much more accurate insurance need. And I think also help clients understand exactly why, that insurance need is there. So what I'm going to do now is I'm going to, if you make a change, I'm going to just have a look at a couple of these chat questions, and then I'm going to unmute. If you make a change directly in the tool and then upload a questionnaire, will the questionnaire data overwrite anything related that you've already added? Yes. If it's in the same entry, yes, it will. How do you account for MPP insurance? What's MPP? Jonathan, I'm going to have to unmute so that we can have a look at that. What am I doing? Sorry. Okay, so now we'll throw it open for questions. Jonathan, I don't know what you mean by MPP.
That's mortgage protection plan insurance. Sometimes people have, it's not as efficient as term insurance, I'm well aware, but some people find it's cheaper actually. Okay.
Well, first of all, let's switch up here. So you can actually create an insurance policy. Let's go to joint insurance, and I'll just use this for a moment. And if I go to details, policy type, and I can link that to a specific entry. Oh, I don't have a mortgage, sorry. So if I had a mortgage on the house, I can now link that to the specific entry. So what happens is if they die, then that's paid off.
Okay. Excellent. That's in the term insurance. We just kind of work around
any insurance policy at all. All you have to do is go to let me just back up here for a second. Let's go to Home, 6 Hour Street. Just as a reminder, with the exception of loans, for instance, that aren't linked to anything in particular, line of credit, personal loan, student loan, whatever. Otherwise, loans are associated directly with an asset. So you can see we can associate loans with portfolios, or in the case of actual assets. If you go to the buy-sell panel, you'll see a financing button so that we can link a mortgage, for instance, directly to the underlying asset. And this is really important for rental properties because, of course, your CCA claim is limited by any interest on any related liabilities. So it'll reduce the CCA claim. So we can't just talk in terms of, general assets and general liabilities. They need to be linked. So all I have to do is click the financing button, and then I can select a mortgage and I can add it. So now that we have the mortgage, let's go down, and now we can click on any life insurance policy that we have, go to details, click the link to, and now when I go to joint, you can see there's the mortgage. So I can link the policy directly to the mortgage, and if Bill dies, the policy or the mortgage is paid off.
Awesome.
Other questions? Now, hopefully, I've been able to record this today, and if that's the case, I will do my best to upload it to our YouTube channel. And just as a reminder, if you go to the website, what you will see in the upper right corner is the YouTube button. That'll take you to the YouTube channel, and then you'll see a lot of different videos on here. And there are actually quite a few if you go back and have a look historically. Other questions? Somebody must have some, surely. Covered a lot of ground today.
I'll ask another one.
Sure.
One thing I've seen is when there's dual income, no kids, they'll leave a share to different parties. I think you kind of touched on that, but but I didn't quite get it. I was hoping you could have a.
How do you mean a share to other?
So, for instance, one older relative passed on 2 shares to everyone 1 generation below in his family, so all his nieces and nephews, and then 1 share to all his great nieces or grandnieces and grandnephews.
Oh, okay. I think what you're talking about, let's have a look at Bill. So I've got the cottage for Bill, and we made the beneficiary Bill Jr. So we can now, if we go to Bill Jr., you see this little symbol here next to the cottage. That means it's linked. So you can see that Bill Jr. is inheriting the cottage on Bill's death, and then the value, his cost based on the value at the time, will be the projected value for the cottage at the time of Bill's death. Okay? And you can actually go 3 generations. So on the About page, I could have Bill Sr., currently owning the cottage. We could have Bill paying all the operating expenses, property taxes, again, not uncommon. And we could have Bill Sr. leaving the cottage to Bill, and Bill in turn leaving the cottage to Bill Jr. You can actually go 3 generations.
Cool. Now, what if it's like a large variety and it's just liquid assets and they just want to leave shares to people?
Oh, well then, again, you're just going to be talking about the percent allocation on the will tab. So remember,
you just have to add all those people.
Yeah, but if they're added on the About page or imported as additional parties, they will show up in the beneficiary list.
Okay.
Okay. As long as you add them, they'll show up. And just as a reminder, if you'll remember, I covered this with the dollar allocation. The add button does not mean you can add a new party. Parties need to be added on the About page. What an add button does is it means I'm adding a line to the list.
Okay.
Okay. Yeah, so you can have this, you can have multiple, you can see down here, we've got Joan, Bill Jr., 50-50. I could go in I could go in and, what did I do there? Oh, I'm sorry, I just dropped it down a level. I could go in and add, I think I got too many going on here. I could go in and add non-party or Susie or, whatever I wanted to do and make it, 33, 34, or whatever. Notice that we're not doing fractions. Right? So you can have as many parties in here as you want. So that would be the percent allocation. And then if we go back to the solutions page, just point out one thing. When you select somebody's name in the list, what you see here are their totals. So if I go to non-party, you can see the dollar allocation. If I go to Bill Jr., you can see whatever Bill Jr. is going to get. Okay. There's no percent allocation for Bill Jr. and non-party and Joan because the residue for distribution is actually negative. So money can't go to them. Other questions?
The taxes, is it possible to see a breakdown?
Absolutely. All you have to do is click on that button, Taxes at Death, and you'll see the projected T2 at the time of Bill's death, and you can see the large capital gain.
Michael, when you did the illustrations with the needs for insurance, it created a illustration, are
Yes,
those
correct.
automatically saved?
Yes, absolutely. And any changes you make, you can see here actually, any changes you make in the Donate Art solution, it said that, you know, Sue's salary was changed. So any changes that you make, if I go to Sue and entries, are we in, no, we're in Life Needs Sue. Sorry, let me go back to Life Needs Bill. So if I go now to entries for Sue, then we'll see that her career income is not there because we deleted it. Remember, we do everything as of December 31st for the insurance calculation. So that Insurance Shield means the current year's kind of locked in. But we don't have Sue's income anymore. But on the other hand, if I go back to the, if I switch back to the main solution, just click the switch button, and we go to Sue's salary, what we see is there's her salary. So in the normal plan, Donate Art, Sue's working, but in the life insurance calculation for Bill, Sue said if Bill died, I wouldn't want to work anymore. I want to be a more conservative investor. We'd only have one car, not two. So what ends up happening is we make those changes to be able to understand what the insurance need is. So that's, you know, to me, it's working interactively with the client to help the client see why the insurance need is there. And then that gives them the opportunity of saying, I don't want to work anymore. Or yes, that's a good idea. I should be more conservative. Now they understand, you know, the need. Because I have a feeling that a lot of people don't understand why they need insurance.
Right.
So,
and with the calculations that are being used to derive that figure of required insurance need, could you just go over the sort of what's going on in the background?
Yeah, it's actually very complex. So, you know, if you look at old needs calculators, it would be how much do you need for your child's education? How much do you need for, you know, whatever it might be, right? Terminal taxes or something. You know, you throw in a half a dozen things. Well, in our life model, it's very different. What happens is if Bill dies you know, everything passes to Sue, we're executing the terms of the will, and we're executing the beneficiaries of the RSPs and the TFSAs and so on. So if we were to look at Sue's income assets, let's say pension plans, you can see it jumps from 270 to, you remember I said, you know, they both have essentially the same thing. But it jumps from 270 to 560 because she's the beneficiary of Bill's RRSP. Therefore, you know, his RSP assets are being transferred to her RSP. And then if we look for example, at the home, you can see now that where are we? There. If we go to the home, the owner of the home is Bill and Sue, but it would become Sue on you know, Bill's death, and then Sue would be the payer. You can see here, and then Sue would be the payer of all of the expenses. You can see they're equally paying the expenses today. But come next year, it's Sue, because Bill's dead, right? So that little P flag is the change of payer flag. Okay, so all the things that would happen in life happen. You know, assets are transferred, payers change, all of those sorts of things happen. And so that ends up becoming now our insurance need. And that's a very holistic approach, and very different from, you know, insurance company software that says, what are your specific, oh, well, we need to have insurance for Bill Jr.'s education. You know, we need to have insurance for terminal taxes. We need to have insurance for whatever, right? This takes the
Right.
more complete look. It just executes everything that would happen in life, plain and simple.
Michael?
And if you're,
Yes.
sorry, just one more thing on that. If you were filling that need with term insurance that at some point will expire and not be renewable, how is that handled by the software?
Well, it's actually,
you can't renew past 85, and then you're illustrating that he's dying at 86. Is it going to recognize that the insurance is gone?
well, no. What happens is when you do a life calculation, you can change the age, but the age is always the current age. You know,
Right.
if you died today, so the term coverage would still be there. But if you were talking about insurance, an insurance need for estate purposes, you know, the capital gains on the cottage going to Bill Jr., then clearly the insurance wouldn't be in force, right? So you would not have the lifestyle need, assuming you had adequate term insurance, because Bill dies today, the policy pays off, but you would continue to have the estate problem because there's no insurance, no permanent insurance, no insurance coverage at the time.
Okay,
Michael?
thank you.
Yes.
On the retirement assessment and on this estate assessment, it's Ed Turgeon, by the way.
Yes.
You're spending all of the excess money that's not been otherwise allocated up until retirement, right?
Up until retirement, correct.
So in this
Yes, there were
needs
two-
analysis, say they had a mortgage that was $1,200 a month, you pay out the mortgage, is that going to then have a lifestyle expense going up by that $1,200 because it's automatically being spent?
No, because it would pay off the mortgage if it were linked to the mortgage. It'd still pay it off.
But the lifestyle expense is spending all the surplus, right? So that expense is gone.
Yes,
Just wondering
but
if
it's
it
still
inflates
yes.
the-
Yeah, but it's still going to it's still the mortgage expense of $1,200 a month, $14,000 a year, is gone, but we're still spending the money. The model would still spend the money because the model is saying we don't care how you're spending, what you're spending it on, whether it's a mortgage, a vacation, or going to second cup. What we want to know is how much are you keeping. So if you went in, you might say, well, if you're not going to be, spending the money on the mortgage, you could then add a keep, and the keep would be, money going into a non-reg portfolio. Assuming you're maxing your TFSAs and RSPs already, it would be money going into a non-reg portfolio, or it could be money that increased your TFSA or RSP contribution. So you would just say, we're not spending it on the mortgage, but we're not going to just spend it, we're going to keep it. So you've got to go in and say, how are we keeping it? Additional TFSA contribution, saving in the non-reg.
So I guess I'm having trouble understanding how it does the cash flow needs when you've got husband and wife both have incomes coming in.
Mm-hmm.
The lifestyle need is basically what they're making, other than what you've categorized as expenses, right?
Mm-hmm.
So you remove one of those on death, that automated calculation of what they're spending on lifestyle seems to be not very accurate on what the family is actually needing for cash flow replacement.
Yeah, but this isn't intended to be a financial plan that's cash flow based up until retirement. This is intended to be a very simple, are we accumulating enough to have the life we want in retirement, right? And so all that matters is, what are you keeping? Are the pots going to grow sufficiently or not? So
the full vision works would be better to do an actual needs analysis for what they're needing.
Oh yeah, sure. Of course.
Okay.
This is a conversation that I had, for instance, with Jonathan yesterday. I got this cartoon which I love, and you can see, financial planning between a rock and a hard place. So I often talk about the concept of referent. And what that word means is that we all understand concepts, by referring to what we think we already know about them or something that's like them. So when you say financial plan to somebody, regardless of what you can deliver, what they're going to do is they're going to interpret what you're saying based on what they think they already know. And what they think they already know about a financial plan is I can get it at the bank for free. The whole point is because you want to sell me, reallocate my portfolio and sell me different investments, or tell me I need more insurance, or you're going to tell me I'm not saving enough, or whatever it is. So oftentimes people's perception of what they're going to get is not all that favorable. So when you say financial plan, what people often do is they say, "Oh, sure, Ed," because they're polite. And then they say, "But just let me know I'll be okay," meaning I don't want to put in any effort on this because I really don't think I'm going to get any value. So the whole idea of one of these plans is to be able to do it very efficiently, but then begin to show people some real value add. And one of the great ways to do that, I think, is through that whole tax optimization. That advisor that I worked with, I guess it was a little over a month ago, the $500,000, if that didn't hook his client into the value of the plan, I don't know what would. So we can start off without putting in a lot of effort on anybody's part, get them engaged, and then what we can do is we can start talking about, upgrading from there. And, if you're into a second marriage, blended family, for example, start to uncover the estate issues that they could possibly face, which I guarantee you other advisors are not uncovering. I'm rambling now, but my favorite story about that is one of our clients in Kingston who prospected a man over quite a long time. And the man said, "I'm okay. I've had a financial plan done. I'll be fine in retirement. Part of getting my affairs together, I've had my will done. So I'm okay." Well, the advisor, continued to contact him and said, do an estate evaluation. So eventually the man agreed. He had a modest house, he had a cottage, he had a whole lot of undeveloped Lake Ontario waterfront property, he had very little in a TFSA or an RSP, but what he had were a lot of rental properties, and they were going to generate the rental income. So the advisor modeled all of this out, used long-term, and this was several years ago, used long-term Ontario real estate appreciation rates, and modeled all the rental properties. And what it revealed was, and the man's will was very specific. This person gets the house, this person gets the cottage, this person gets these rental properties, whatever it was. And it was obviously, that was his thing. And then he modeled it all out and said, based on these long-term rates between CCA, recapture, capital gains, and everything else, your estate's going to have a $2.4 million bill, tax bill. And, no liquidity. So the man said, I believe in real estate. I want to pass this on to my children. And he bought a $2.5 million permanent policy because nobody had uncovered it. So we go from a retirement assessment to get them engaged, a retirement and estate assessment so we can uncover any estate issues, and then we can, move into a full financial plan. By that point, if we don't have clients really on board, I don't know what it would take. That's my view anyway. And all of this is our one-time investment in doing this work for life, right? I mean, sure, it takes some time to do it, but once we've done it, we've got the model, and now we can work with it year in and year out.
So you can update the figures year over year to actuals?
Sure, absolutely. What was your portfolio worth when we started, a year and a half ago, and what's your portfolio worth today? Well, markets have gone up a lot, so we need to update. and review your wants. People's wants aren't static. That's why, I believe in a life approach. How much income do you want in retirement? 60 grand. It's often called a one and done figure. You go back next year to the client, where's your value add? I don't see one. We're going to update for portfolio values, but otherwise we're still working with, did your desire to change your spending, is that varied from the 60 grand? Well, not likely. But if we're doing more of a life approach, I want to, take these vacations, I want to renovate the kitchen, I want to do this, people's wants change. So, we're able to always be relevant is the point. Sorry, I'm rambling a lot. It must be Friday, and I must be tired after getting the release out earlier this week. It was very tiring. Any other questions? If everybody's okay, then thank you.
I wouldn't mind hearing, if you don't mind, you mentioned that story about the advisor who ended up getting the $2.4 million permanent policy by going through that. What are some other good finds that you could help our clients with? Like, you had the house-rich cash poor situation with the needs, and then that example. Are there any other big ones that kind of...
Oh, well, I eventually we'll talk about this, but I believe that there are 5 main planning themes. And we touched on them briefly yesterday, but the 5 themes are house rich and cash poor. You've got the big house, your net worth looks great, but it's all in the value of the house and the cottage. And you're not saving enough because of the mortgages and the costs of running them and everything else. You're not building sufficient income assets. So it's house rich, cash poor. And it means that unless you can figure out how to build those income assets, eventually you're going to have to downsize. Another theme, which is, I think, very commonplace, is what I call the large latte factor. Easy for people to understand their sources of income, career income, maybe rental properties, that kind of thing. But when we ask them to identify their uses, very often they woefully underestimate them. And therefore, the model has them saving a whole lot when, in fact, they're not saving much. They're spending it. They just don't know where it's going. So we have the ability to show them the implications of that to help them get control of their latte factor. Another theme is what I call net cash. And what it basically says, and right in here, what I've got going on, you can see the negative cash flow, is I've just got kids at university. So what's happening in this plan is more money's going out than is coming in, and people get all anxious about it and think the world's coming to an end because they're, having cash flow problems. But they lack perspective, and the perspective is it's very short term, and eventually everything is going to be okay. And then a fourth theme, which is very common amongst retired people, the fear of running out of money, and therefore they're not living life the way they want to. And we can show them, you've got tons. The advisor who called me about the client, the Ottawa client, the $108,000 pension, I can remember a few years ago, his father used to go to Arizona for 6 weeks, mid-February to the end of March, or end of January to, mid-March, whatever it was, and quit going because he didn't think he could afford to. So the advisor did a plan for his father. The income asset forecast at life expectancy was $750,000. He threw in, I think it was $6,000 a year he used to spend on his 6 weeks in Arizona. So he threw in $6,000 a year for 5 years, $30,000. Didn't put a dent in the plan. So, you know, we're able to help people say, you can do things if you want to. It may not be for yourself. It may be contributing to your grandchildren's RESPs or whatever. But, you know, it's okay. You can actually spend more. You know, years of accumulating and then difficulty sort of shifting. And then the final theme is what I just call the high net worth theme, which is, you know, there is no problem. You've got a lot of assets. The problem is because you've got assets, whether they're cottages or rental properties or whatever, you've got a big estate problem, big tax problem for your estate. So, you know, very common. And I think the true value add for high net worth clients, by the way, I think saying you'll be okay in retirement is a ho-hum. I think it's uncovering estate issues that's most important. I don't know if that answers your question, but
that's great. Thank you.
We'll eventually get to it. And I don't believe I've ever seen a plan that I can't look at and right away understand what the theme is. I can remember being buffaloed on one occasion, and it turned out that these people were very high savers, but what they had just done was they took all their savings and they paid off a mortgage. So I was looking at free cash flow, saying, well, if you've got all this free cash flow, where's the non-registered portfolio? This is the large latte factor theme. Well, it's because they paid off or used it to make a significant pay down of their mortgage. So, any other questions? Okay, well, thank you for your time and enjoy your weekend.
Thank you.
Thanks, Michael.
Okay, pleasure.